Hello and welcome to Options Guide TV. My name is Brian Overby, author of the Options Playbook, and I will be your host here for about the next 25 minutes on Options Guide TV. We're getting into earnings season. Banks are usually the companies that kick off earnings season. I always like to think the beginning of earnings season with JP Morgan's earnings announcement. So let's do a trade on JP Morgan. We're going to lean into this earnings report, and we're going to look at a skip strike butterfly. JP Morgan's going to be announcing on July 14th. That's a Tuesday. They're going to announce before the open. So the strike that we're looking at is next week. We're going to look at the July 17th expiration. So let's run to the Tradio Pro software. And if you have any questions along the way, please do put them in the chat box. But we'll get busy with a bunch of trades around earnings. And in particular, we'll do quite a few on the financials. Once it's a sector that we're seeing money flowing into. This sector has held up well. There's been a little bit of a pushback against the AI space and some of the AI trades. They're just very volatile at this point in time, but it's not. The NASDAQ and the Dow actually have a fairly decent divergence recently in that we've seen the Dow Jones Industrial Average be setting new highs, and we're seeing the NASDAQ actually week in and week out have, troubles to get to new highs. So the AI trade and the CapEx spending has been a huge concern. And so let's lean into the financials. That is one group that has benefited from the rotation, if you will, from the AI space into, I guess you could say, safety. The financials have underperformed for quite some time, but now at this point in time, they're actually performing better than the S&P 500 index. And we've had a little bit of a sell-off recently. So I'm going to look at two different trades in JP Morgan. The first one I'm going to look at is the skip strike butterfly heading into the earnings report. And then on Monday, we'll probably look at our normal open wing butterfly that we'd like to do around earnings. The market is going down. We're down 2% on JPM right now. It's down $6.75. We're going to look at the July 17th expiration. They announce on a Tuesday. So you have all day Tuesday, all day Wednesday, all day Thursday, all day Friday. So there's quite a few days that are involved in this expiration after the earnings report. So sometimes with the skip strikes, I'd like to I would rather have them announce on a Thursday than on a Tuesday. So you get that big event and the vol comes out of the underlying, and then you get the huge time decay. But I don't mind this trade in that we have 1 week until that expiration date, and we're in a financial stock. We're not in a AI stock that has had a fairly decent run up. A lot of the deal-making stocks, JP Morgan, Goldman Sachs, and as a matter of fact, we can take a peek at the chart right now. And the fact that we're down 2 today, it kind of shows some of the chop and some of the volatility that we've had just recently in the financials. So here's some of the chop. Look at all the red mixed in. All the red are down days mixed in with all the white candles that are up days. And we've just kind of been hanging in this range. Now let's go out 1,500 days, go all the way back to the beginning of the year. And we see that we're finally kind of making some headwinds, but we just broke through a new high, and we're having problems establishing a new high to the upside where the next leg up is going to be. But here is some of the strength that we've seen, a little bit of sell-off, a little bit of a pullback. I don't mind selling something up here. I don't mind doing a short call spread. So if we did a short call spread, but we're going to do it with a skip strike butterfly. But if we did a short call spread, and let's say we went 5 points wide, tried to manage the risk, we're going to be speculative because we're going to do it around earnings. If we looked at selling, and I'll just do a real quick one here. We sell the 350, buy the 355, 5 points wide, 70 cents. Not bad, right? You have 5 points of risk. You're looking at right around a 1 standard deviation move. The delta's at 16% would be a 1 standard deviation move. The expected move on the stock, I'll do the math real quick, $7 and $7.45. So that's $14.45. That's the expected move around the stock. Stock is trading at 332 plus 14.45. We're looking at 46.45. So 45 strikes should be about a 20 delta. It's 25. Okay. 47. I guess that would make sense. 46.45, 47.5 is the 20 delta. That's about where the expected move is after the earnings. And that goes out to the July 9th expiration. So the over under as to how many points the stock could move if we bought the at the money call and we bought the at the money put. That is by just looking at the extrinsic value. The midpoint is basically what this is. 730 plus this midpoint over here, $7, $14.50 we'll call it. And that gets us right in this range. So we're outside of that range. We're about a 1 standard deviation move away, and you're pulling in a 78-cent credit. Now, around earnings, I don't like this trade because the risk-reward ratio isn't that awesome. So I'd like to give up a little bit of credit and put in a hedge. And so we're going to use the credit from selling the spread to buy a butterfly. And this is the range that we're going to hang out in, with a $300 stock, implied volatility starting to creep up in JP Morgan. And the earnings report is July 14th, 2026. This should highlight earnings right here. I don't know why it's got the earnings date off. Vol's at 34. Vol hasn't really creeped up a ton. Well, let's set it up. Here we go. Expected vol to be a little bit higher at 34% implied with the earnings right around the corner. But I've double checked it. It's actually July 14th. So in the chart here, it's not showing it the correct earnings date. The earnings date is September 3rd, and that's not correct. It is July 14th, and it is before the open. Okay, so here we go. Let's set up. Let's go 350 strike, 355. We'll probably have to do the 352. So we're going to change this up a little bit. We're going to buy the 350. We're going to sell 2 of the 3250s. And if we kept it this way, we would skip the 355 and buy the 357. 20-cent net credit versus 70 cents if we did that short spread. Short spread is it's about right. Let's try it going 5 points wide. We're going to send this one to the what if calculator. And I don't know if we go 5 points wide, if we can get it done for a decent net credit to the account. Let's try it. Let's go bid. Buy 2. Sell buy. Yeah, that's a small net debit. So 50 to 55. All right, so here is what the paper trade is going to be. Let's go and look at the what if calculator, and let's talk a little bit about it. We're bringing in a 20-cent net credit as opposed to a 70-cent credit if we did just the short spread outright. I'd really like to get 30, 35 cents. I usually like to try to get somewhere about half of what the normal credit would be if we just did the short spread. But in this instance, we're 20 cents. We're gonna roll with it at this point in time. And that means that with the stock at $332.70, if the stock stays under the strikes of this skip strike butterfly, under the 35 strike call, you can make 20 cents. The market opens and does the expected move. You're going to land right in here, somewhere within that range. Now, remember, expected move doesn't have any regard to direction. So if it goes down that amount, that's fine. If it goes up that amount, well, we're still looking solid on the trade. We have this expiration out until Friday. So to start with the high implied volatility, we would be down on that trade. As vols come in and as expiration approaches, eventually the green line starts morphing into the profit and loss at expiration. So if we send this to the trade ticket, 2, 3, we are looking at a 1 by 2 by 1, pulling in a net credit of 10 cents. I want to get at least 20 cents. I don't want to send that to the floor at that price. I don't want to send this trade for 10 cents. I want to at least get 20 cents on the trade. Like I said, ideally you're looking at 30, 35 cents. That would be half of that net credit of that spread. But right now it's looking like a 20-cent net credit. And then our risk doesn't kick in until we get to about 355. So this is where our skip strike is at. This is the strike that we skipped to establish the butterfly for a net credit. And that's got an 11 delta. So there's 11% chance the stock would be at least 1 cent in the money above the 355 level. And if we look at the what if calculator, that's where our break even is at expiration. And expiration is going to approach quickly. They announce on Tuesday, got until Friday. And then this is our risk. If they blow through the numbers, we have risk all the way up through this range. And as the implied volatility comes down, where this is helpful here, what's going to eventually happen is this green line will start morphing into the white line. So if we woke up Tuesday morning and the stock was up here, we would just want to close it out. We want to capture as much implied volatility premium because we were wrong about our outlook and the stock blew through the numbers. If the stock lands within this range, that's great. We could put it on for a net credit and also receive a net credit. But ultimately, we're looking to just pull in this net credit, and we're going to try to get 20 cents on this trade. So we're doing a 1 by 2 by 1, trying to get this done for a net credit of 20 cents to the account. And our total risk on the trade would be $2.35, which is 16. We'll call it about $2.50. That's the width between the spreads. That's going to be the margin requirement minus whatever the net credit is received. Now we're going to hopefully get 20 cents to send this trade to the floor, and that's going to be our skip strike butterfly that we're going to do ahead of JP Morgan's earnings. And let's look at a Goldman Sachs trade today too. We got a few more minutes. If you have any questions, please do put them in the chat box. I'm happy to address them at any point in time during the show. Good morning, Kurt. Welcome back and welcome in. All right, let's look at, let's send this one to the trading floor. Okay, so JP Morgan right now, let me set up the situation. JP Morgan, with the stock trading at $332.55, they're going to announce earnings on Tuesday before the open. We're down 2% on the day. We're going to look to do a skip strike butterfly with the July 17th expiration, the expiration that happens the week of earnings. It's 9 days away. We're going to look to buy the 350 strike call. We're going to look to sell 2 of the 350 250 strike calls. And we're going to buy 1 of the 357.50 strike calls, $357.50. We're going to try to get this done for a net credit of at least 20 cents to the account. That means 20 cents for every 1 by 2 by 1 skip strike butterfly that we establish. Our risk kicks in at the 355 level, that strike that we skipped, and it's 2.5 points minus whatever net credit we are received. And we're going to send this down to the trading floor. Boom goes the dynamite. Order has been sent. All right, now let's go in and take a peek at when Goldman Sachs is going to be announcing earnings. Now, that's a little bit more expensive stock, and let's see what we can get done for that. The Goldman Sachs is down 2.2% today, down 23 on the day. And they're also announcing on July 14th. And that would be before the market opens. So the exact same day as JP Morgan. Sometimes it happens. It's not an anomaly, but usually JP Morgan's is the first, and then Goldman Sachs will announce it a few days later. Okay, so Goldman Sachs, 45% implied volatility right now, down to 46. We're looking at 1,020. 22 points down, 2%, and expected move. So we're talking 30 and 20 cents. So 50, we'll call it 57 points to the upside. If we round up, we add 60, we're looking at 1,080 on the upside. Now, remember, I'm looking at bullish trades here. So the expected move, what the at the money straddle is trading for, and we'll go over that real quick. Let's clear this one out, and we're going to add this and this 59 points. That's the expected move. That is, to me, the over under. That's the line in the sand. The marketplace says if you buy the long straddle, we don't think we'll sell it to you, but we're going to sell it to you at a price that we don't think will happen very often, which is at expiration around 60 points. So the expected move is going out to the July 17th expiration. It's pulling in $60. If you think it can make that move, well, then you buy the straddle. If you think it can't make the move, then you sell the straddle. And that's why I think of it as the over-under. If you're talking about a football game, what are the total points that would be scored? Is it going to be 45 points? Can they score more, or will both teams score less? And this is the way I'd like to approach the expected move when we're thinking about earnings. And the expected move is always relative when you're using the options to the expiration date in that option. So going out to July 17th, they're saying that this is, and it usually ends up being right around a 20 delta when it's all said and done. So we add 60 to that, the 180, that's a 22 delta. 2240 is where the 180 is at. And then if we go further out, now we can get something a little bit interesting just on a one contract basis. The fact that it's a little bit more expensive underlying makes it a little bit more interesting because you can get a little wider on the trade. So we're going to try going right at the one standard deviation move, 1,090. Let's sell this, and let's see if we can we go 10 points? Yeah, we can go 10 points. And we need to buy that one. Buy, sell 2, skip the 10 and buy the 20. A little bit higher requirement, 95-cent net credit. Yeah, I like that. I like this one a little bit better than the JP Morgan one. Now you got on the JP Morgan one, we're trying to bring in 20 cents and we're spending $2.50 in the margin requirement, $2.50. Now it has a lot to do with the fact that it's a $322 stock versus a $1,020 stock. Both stocks have done well since the beginning of the year. Been a lot of the SpaceX deal, they had their hands in it. Both of them did. And so at this point in time, we're down. We're getting a net credit of 95 cents. They're announcing earnings next week. We're 10 points wide on the upside here, but we have, instead of a $250 margin requirement, we're going to have a $1,000 margin requirement minus The net credit received, we'll call it $1. So we're looking at 9 points of risk. We'll send this to the what if calculator. So we could do 1, 2. Yeah, that's interesting. So in the JP Morgan situation, for the same amount, we could do 4 of them, and we're going to come close to getting the same premium then. We'd be bringing in, if we got it done for 20 cents, we'd be bringing in 80 cents, but it's a much tighter width between the spread, which does affect time decay. You want the further out of the money option contract to decay, you want that center strike to decay as fast as possible. So I kind of like the fact that we can go 10 points wide. We have a little bit more risk, but we also have a little bit more upside. Well, 2.5, if we did it 4 times, I guess we're fairly close on the upside too. So it's a very similar trade if you're looking at just capital that it takes to put the trade on. They're very similar. They both announce on the same day. So here is the trade. Let's look at the Goldman Sachs one. I still am leaning towards the Goldman Sachs one. I like this one a little bit better. Stock right now is at 1,020. If we put this trade on, we bring in a net credit of $1. Everywhere below this strike, below our first strike, the 1,090 strike call option, we can make that $1 on the way up as expiration approaches and implied volatility comes in. We're going to start drifting from right here all the way to the Friday expiration. Max loss would occur way up here at the 1,120 strike, and that max loss, and then this would start drifting down. If after earnings we opened and we gapped way up, we still got some chance to try to grab some premium, some time premium, and that kind of buffers us on the upside. And this would be our max risk on the upside there. So now where our break even is going to be right about the 1,110. It's actually that plus the $1, that net credit. And there it is right there. Let's leave it there. Received at that midpoint. And that would be our break even point. And that's about a 13 delta in this instance, 13% chance of that finishing 1 cent in the money or more after the expiration date. Yeah, I like this one a little better. Just overall. All right, so let's do it. Let's set it up. All right, so Goldman Sachs. This will be our second paper trade for the day. We'll make it an official paper trade. I'll try to get it executed inside the portfolio. Goldman Sachs is going to be announcing earnings July 14th, which is Tuesday before the open. Stock is trading at $1,020, down about $23 on the day, or 2.23%. We're going to go on the call side of things, and we're going to go about a 1 standard deviation move out of the money. We're going to look to buy the 1,090 strike call, sell 2 of the 1,100 strike calls. We'll be skipping the 1,110 strike calls and then buying 1 of the 1,120 strike calls. This is an alternative to doing a short call spread. And by doing this, we're using some of the credit from a short call spread to help pay for a butterfly to hedge our position because of the risk that the earnings brings in. Now, the maximum it could trade for, we could put this on for a net credit of $1. It could trade for as much as $10, which is the difference between this strike, the 1,111 strike, minus the 1,090 strike. So if it went out right at the middle strike, maximum this could trade for is $10. You'd put it on for a net credit of $10, and you would take it off you put it on for a net credit of $1, and you could take it off for a net credit for as much as $10. Your risk kicks in at the $1,111 level. From that point on up, you at expiration, you have risk from 1,110, the skip strike, all the way up to 1,120, which is also 10 points, minus that net credit received, or $9 in that instance. And that's going to be our second paper trade in the financial space as we head into this earnings season. So let's send this down to the trading floor. We're going to work it at a $1 net credit. Right now it's showing the midpoint at $1.17, but we'll send it at $1. I'm going to send it down to the trading floor. Boom goes the dynamite. Order has been sent. So we got 2 orders working right now. We're working on the JP Morgan order, 1 by 2 by 1. Ideally, if we did this, and I might go in and adjust this, I'd do this 4 times. because that would be the same requirement as the Goldman Sachs trade. And we'll watch them both and see how they both play out. Limit of a net credit of 20 cents on the JP Morgan one, net credit of $1 on the Goldman Sachs one. And we'll ride these on into earnings. On Monday, we might come back and get a little bit more bullish and lean into an open wing butterfly or something. We'll take a peek at it, see if we want to get bullish that way. Sometimes when stocks like in the financials that have done well, and this has happened in the AI space a couple of times. We saw it with Micron Technology recently, where stocks had really good earnings reports, and they took that as an opportunity to sell the stock off. And I think that that's a potential situation here with JP Morgan and Goldman Sachs. So there we go. We're right at time. It's 11:30 Eastern time. And let me check and make sure we have any questions that we want to answer. No, we're going to leave it right there. My name is Brian Overby. Thanks for stopping in. We'll be back on Monday for the next edition of Options Guide TV to look at these trades. On Friday, we're going to do another edition of Fundamental Friday, where we break down the fundamentals of option trading. So come back. If you'd like to learn more about the basics of options, come back this Friday for the next edition of Fundamental Friday on Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.